Weekly review of the market. How are you guys? As usual, we are seeing the market starting in slow mode today. But anyway, we will going to start with a review of the calendar and the most relevant macroeconomic data we have for today. And after that, we will check the market and see which are the main market movers or the most interesting levels to watch this week. Okay. Anyway, here we are with the fundamental calendar with the macroeconomic news. And as you can see, we have a pretty busy week ahead. So far, we have seen the PMI readings, manufacturing in China and Europe. And overall, the data was pretty much in line with expectations, with a better than expected numbers in Europe, which for me, are signaling a strong footing in the beginning of this fourth quarter, right, in the region. However, the euro is slightly lower, and that's because better than expected numbers are favoring stocks today. European indexes open with a tepid tone, then surge, and that's keeping the euro under pressure. Anyway, as I was saying, we have a pretty busy week, and so far today, the only piece of relevant data I had is the ISM manufacturing PMI in the US. The fact is that we're expecting barely a 50. You know that in this kind of indicators, 50 is the line in the sun that divides expansion from contraction. So if we have a reading below 50, that would be really bad news for the US and really bad news for the Fed and the probable rate hike, and therefore should signal a strong decline in the greenback for today. Also, this week we have a couple of central banks meeting, also starting with the Reserve Bank of Australia in the upcoming Asian session. True is that there's no rate change in the rates expected in Australia, but latest tepid and poor, really shockingly poor inflation figures in Australia had put an interest rate cut back in the table, right? The fact is that over the past meetings, the statement has been pretty hawkish, right? So with the bank saying it's comfortable, officers are comfortable with the ongoing situation, with the ongoing growth, and with the ongoing value of the Aussie. If they change the tone a bit more dovish, that could weigh on the Aussie as the market will run to price in a probable rate cut for the upcoming months, right? We have a speech for Draghi tomorrow also, but I don't believe it's really relevant. I do believe that the next interesting reading we will have would be the ADP in the US, because once again, we are in wait and see mode ahead of whatever the Fed may decide in December after they say they may lift rates then. And the ADP will be the first tip we will have over what the Friday's payroll may bring, right? We are expecting a lower reading, 181 against 200 previous. I would really like to see this any employment creation number going on above 220. Keep in mind that at the beginning of the year, at the end of 2014, we were talking about an average monthly basis of 240. And for me, that's the level of growth, right? 240 is the level where employment is actually growing. So if we have something more closer to 240, 220 or more, then that will be a signal, right, that employment is picking up and we can get a lift in December and the $4 strength, right? Services PMI is expected better than expected in the previous story, but keep in mind that the service sector has been the one growing the most worldwide, right, for the past 4 or 5 months. Okay, so that would not be a real shocker. Also, we have another Super Thursday, in UK, where we have the central bank meeting with rates, facilities, minutes, and policies changement, and we have an inflation report also this month. So it will be one of those days when we have a lot of data. My take is that, of course, we're not going to see much change in the year, in the usage for trades program, not in rates, not in the composition of the officers' votes, right? The level, the key report to watch, the key inflation data will come from the quarterly inflation report. We are seeing really depressed inflation all through for Europe. So we need some hopes coming from the statement, from this presentation, to see the pound actually rising. We are going to talk about the pound, which was once again rejected by 155 today. Following that, we have Bank of Australia policy minutes, the minutes of the latest meeting. It will be interesting also, but it won't have so much impact that the one released later this Tuesday, right? And finally, on Friday, we have really relevant data in the UK, which is manufacturing and industrial production. These are usually huge market, big market movers, but considering that they will be released a couple of hours before payrolls in the US, I don't expect much market reaction here. Before payrolls, we tend to hold on ranges and wait for payrolls. So actually, not much from this data. However, if the numbers are good, keep in mind that will be supportive for the pound in the mid-long term, right? Also, another thing that we should care about this Friday is that we have Canadian employment data alongside with the American one. That said, that means that if the pair, dollar against the Canadian dollar will be a pair, not maybe the best one to trade, because if the data diverge, we are going to see spikes up and down in the cross, and that's not really recommendable and it could be too risky. Anyway, we are expecting a better than the previous number, 180 against the terrible 142 we have in September. Still, I do believe that this is a poor number. I would like again to see it above 220 to talk about a stronger growth in employment, and therefore more chances of a dollar run. Okay, unemployment rate is well below the Fed target 5.1. We are okay there as long as it remains at 5.1. That's not going to be a big trouble. Keep in mind that the three numbers to watch are the release of Nonfarm payrolls, any review of this previous number, and the unemployment rate. If this number is revisited either up or down, that could also weigh on the market. Okay. Anyway, so let's change. Sorry. Let's change that to charts. And here we are going to see a bit of what's going on in the market. Sorry. Anyway, the euro remains pretty well bearish, pretty depressed. It had a couple of bad hits over the past couple of weeks, and I don't see much of a reason why the euro can appreciate from the macroeconomic background. And technically, we are seeing the pair struggling to hold its gains above 110. Honestly, I do expect this level to ease, right? I do believe that the 110 can ease, and we can go back to Thursday's lows, 890. Although the critical support for this week comes around 840, where we have several daily highs and lows ever since early May, late April, right? Pair has bounced intraday many times from that region, so that's the critical support. If we somehow see further weakness in the pair and a break below this level and a weekly close below it, the risk is towards a retest of the year low, okay, for around 490 or so before the year end, right? But anyway, that's the main support and the main level to watch. Also, I have been following this 200 simple moving average in the daily chart, 1080. Ever since breaking below it, it has been attracting selling interest. So that's the immediate resistance for me. I do believe that we are still going to see some selling interest around that level. And if we manage to regain it, maybe we can go up to 1160 or so, which is another strong static resistance level. Okay, 1160. I honestly don't expect much of a dollar strength, a euro strength, sorry, unless we have a really terrible, disappointing payrolls on Friday, which may lead to an advance up to 112. But still, I do believe that this one is a sell the rallies, right? And for the pound, I was watching today that the 155 level, right, around here, has been attracting selling interest ever since rising near it. in early October. We have been below 55 with a couple of big spikes shortly once ever since mid-September. So we really need to see the pair establishing above this area to regain some more momentum. If not, I do expect some range. Honestly, the pullback we have just seen has been quite limited. We are holding 40 pips below the level, so still not clear whatever the pair may do right now. I'm watching my forward charts that we are a bit overbought and with some signs of exhaustion to the upside, but for the most, we need to break that level to confirm an upward continuation clearly for this week. And to the downside, I do see some strong support in this area 54.10. Sorry, we have stalled there many times over the past 2 months. We lost that level. We can go back to those lows around 52.50, but still will be in within range, right? Keep in mind that, as usual, the market is being led by whatever the central bank decides. So my take is that as long as the Bank of England remains in the path of rising its rates after the Fed in the first half of 2016 or whatever they said, the declines in the pound dollar will be limited. And contrary to what I have just said in the euro, maybe this one is buy the dips, right? Not sell the rallies. The dollar Japanese yen, it's continuing ranging with little directional strength. I still believe that long-term outlook tends to be bearish because the price has been unable to break above its 200 simple moving average in daily chart. Approaches to that level had attracted selling interest continuously ever since August. So I don't know, we are less than 100 pips away. I would like to see the pip breaking through these highs, guys, 2170, 2180. That's the level we need to take, right? It will depend, of course, on where we stand on Friday, yeah, and how strong or weak the payroll gains, right? I suspect we have plenty of stops above this level. And if we take them, we can go back up to 2350, that region, that area in here, right? But in the meantime, I'm not seeing it very clear. And honestly, in the short term at least, right? If we break through 120, we can go down to 1930, 70 pips. There's not much room in here, but for the most, the pair has been trading 250 pips for over 2 months already. So not much action going on here. We are hoping, really hoping, we have a breakout sometime in the upcoming days. Okay. One other thing I have been following is the continued decline in gold prices. The fact is that ever since in September, the Fed said that they are not going to, or they refrain in September, sorry, of rising rates. Gold entered the bullish momentum, right? Reach 11, almost 1120, almost 1200, and there we go when the Fed said we are considering December plum, the commodity plum, and it's currently trading around the 61.8% retracement of this October rally. So beware that as this a break below this level could send the pair back to those lows around 1070 we have. And I'm watching it particularly because the euro is behaving, it's pretty strong correlation with gold prices, Gold will continue to trade purely on Fed, right? On market sentiment towards the Fed. So keep that in mind. If the gold plunks, the euro will probably follow. As I was saying, we have the Reserve Bank of Australia today. But if you take a look at the forward charts in the upside seems pretty limited. The fact is that we had tepid Chinese data over the Asian session at the beginning of the week, and we're waiting for the Bank of Australia, right, decision. So I don't see much of movements at this point. But anyway, I do that we have for this week some resistance around 71.70, right? And above that level 72.40. The pair for me will only become bullish if we manage to recover somehow above this 72.40, and then we can rally back to those highs near 74 we see early October, right? If not, honestly, I do believe that the risk remains towards downside for the Aussie, and we may fall back, particularly if we lost the 71 level. Right now, I don't see much in the way until 74 to 70.50, this area, okay? And if we lost that one, then go back below 70 seems pretty logical. Uh, with poor poor readings in China, sorry, and commodities giving up ground, uh, the risk is pretty towards downside in the Aussie. Another one that you should keep an eye on is oil prices. The fact is that this recovery in oil prices by the end of October has little fundamental background, because we are still seeing an oversupply market, and we are still seeing shrinking demand all over the world. And well, we have that tepid poor GDP reading in China, which means they are going to import less energy derivatives. So I do believe that the risk in here is towards downside. I don't see much of an upward potential. In fact, if you take a look at the commodity corrected by the pip, by the cent, towards the 50% retracement of its latest decline. So I do believe that the risk will turn lower, particularly if we lost 45, which is a psychological level for the most. Okay, I do believe that that's pretty much it. I'm not sure if I have much more to say, except that beware of whatever the market brings ahead. Keep in mind that we have a lot of action coming from payrolls, and that the market continues to be central in whatever the central banks decide. So any tip of whatever they do or they say or they plan to do will be key. Okay, thank you and see you next week. Bye bye.